The seminar today is presented by Jose Antonio Perez Rodriguez, Training Coordinator at the BM Institute. Welcome, Jose Antonio.
Thank you.
Before getting into the details of the session, I have just a couple of housekeeping announcements to make. So I will ask participants to please mute yourself and close the video. There will be a Q&A session at the end, but please feel free to interact with the presenting during the session. So you can either do this by writing question via the chat or use the small icon on top of the screen, so to raise your hand so that the speaker can see you. So please also note that the video will be recorded. So as many of you already joined last week, I will skip through these introductory slides that you will anyhow receive afterwards. So just very briefly on FESE, we represent 36 exchanges in equity, bonds and derivatives, as well as 13 MTFs. So today we will focus on derivatives markets, so both looking at the trading and the post-trading. So the session will cover what is a derivatives, why and by whom are derivative trading, where are they traded, so exchanges versus OTC markets, what are the main functions of a CCP, and finally we will look at the regulatory landscape, touching upon the MiFID framework, EMIR and CCP recovery and resolution. Understanding the difference between equity and derivatives market and why a provision that might work in the equity space cannot in some instances be replicated for derivatives market is key. And we really hope that this session will help you to understand why equity and derivatives are not comparable. So Jose Antonio will present this very much in detail, but we just had it here a sort of high level slide in which we highlight the difference between a security and a derivative. So a security being a general term for equity shares, bond and ETFs, whereas in the derivatives market, a derivative is a contract that derives its value from the performance of an underlying asset. So most security give a share in the ownership of a company or its income, while a derivative contract gives to the buyer the obligation or the right to purchase an underlying asset at a specific future date. So this and much more will be explained today, as the session will of course have an introduction to derivatives, then focus on future and options, the role of exchanges, the central clearing counterparty, and as I mentioned, a short regulatory overview. There will be, as mentioned, also a short Q&A session at the end. So without further ado then, let me hand the floor to Jose Antonio. Thank you.
Thank you, Sarah. Let me take the control. Yes, now it's fine. Thank you for the welcome and the presentation. Sarah, is very nice to see many participants today here. This session is going to talk about derivatives from the very beginning. I wouldn't assume any previous knowledge about this, and please, as Sarah mentioned before, feel free to interrupt, raise any question either verbally, unmuting your microphone, or through the chat, although at the end of the session we will be sharing some minutes with the questions and answers. Yes. Well, the introduction of derivatives makes me explain or define that what a derivative is. Mainly here we are going to be focused today in futures and options, but there are some other derivatives, as we will mention before. A financial security derivative is not other thing than a financial security, which depends, whose price depends, among other things, on the underlying asset. Of course, some other aspects are interest rates, are dividends, or also volatility. We are going to cover briefly all that. So derivatives allow the investor to manage the risk associated to an underlying asset with no modification of the position in that asset. Let me please take advantage of the whiteboard I have behind me. You can click in my image. You can click on me. Probably you will see my face more darker now, but hopefully you can see the whiteboard. Today is December 9th. Today is December 9th, and we have our favorite investor, Pepito. Pepito wants to buy a future. He wants to buy a future at the price of, let's say, 8,600 points. Which means that, please, as I mentioned before, feel free to click in my image, in myself, and you can see the screen larger here in Teams. Okay, thank you. Now I prefer to focus here. When one investor buys a future, he is obliged, when buying a future, he is obliged to buy an underlying asset at a future date. And this future date could be, for example, December 17th, which is the third Friday of the month. Given that at this date, this underlying asset could be in 8,800 or 8,600 or 8,400. Any of these three scenarios could be reached on a future date. And I chose December 17th because at least in the Spanish derivatives market and some other markets also, the third Friday of the month is taken as an expiring date. This is the expiring date, December 17th. Okay. So the key aspect I would like to focus now in the slide is what it says there in the final paragraph: a future exchange compromise to be executed at a specific date, on a specific date. This specific date on my whiteboard was December 17th, which is the expiration date or maturity. And in its investment, it's not necessarily the payment of the principal. So going back to our whiteboard, we have to deposit here some margins, deposit margin, okay? That, as we will see later on, will be 1,000 in the case of Spanish derivative, but we can work with some other derivatives, and you have information about other derivatives or organized markets in Europe in the annex. Hopefully, probably we will not cover this annex documentation, but let's see how the session continues. In fact, these derivative contracts has two bugs where they could be located. Regulated markets, as you can see in the upper part of this slide number 12, where you can have futures and options. Our session today is going to be focused in the organized markets. Given the virtues that these organized markets have, as deep liquidity or absence of counterparty risk or legal risk. We will mention that before. Sorry, we will mention that later on, as opposed to the over-the-counter markets. The over-the-counter or non-organized markets, we have their forwards and swaps, some other types of derivatives which have both counterparty risk and legal risk. When talking about the derivative, we can have several underlying assets. Not only IBEX 35, which I was showing here, the Spanish benchmark, but you can also find some commodities as oil, gas, coffee, or maybe currencies or interest rates or bonds. But given that initial definition, and I don't know if so far we have questions, comments so far. Fine. Can we continue, please? Good. Yeah.
Maybe just one question, Jose Antonio, if you allow.
Yes.
Well, with regards to the definition of options, I'm just wondering if the holder of the right doesn't want to buy and sell, what happens with the option? Does it just vanish? Or does he maintain it?
Well, please let me answer you later on once we cover options, but an initial answer already would be the following. The fact that this option is traded in an organized market, and thank you for your question, means that a CCP, a central clearing house, would be in charge trying to avoid counterparty risk. So, in other words, at an initial step, market members would be in charge of this possible default there. And the second and last resort mechanism, we will use the CCP. But as I told you before, please let me be more specific and more clear later on. Okay? Is that okay?
Sure. Thank you.
Thank you, Benjamin. Okay. What is the use? What is the real use for derivatives? Well, here we are imagining a farmer which is concerned about the wheat prices will go down and he will not make enough money to cover his costs, as opposed to a baker which is concerned that wheat prices will go up and he will have to increase prices to cover his costs. Both of them tries to agree a specific price, trying to mitigate their market risk. We will talk about market risk later on, and we will try to, they both try to reduce at a maximum level uncertainties, which means that everyone can benefit from this trade. But of course, this is a very initial and very schematic way of putting this. We will be more specifically later on. Because traditional hedgers typically include producers and consumers of commodities, of owners of assets, subject to influence, subject to changing prices. So something I would like to mention from the very beginning concerning derivatives is that derivatives likes a lot volatility. Prices goes up or prices go down. And that's why sometimes we can see some underlying assets whose main or initial financial product launch into the market are derivatives. Hedgers also include businesses with a cross-border element, but as we will see later on, trying to hedge your position using a derivative is only part of the truth. Derivatives, as we will see later on, they are used for speculation, hedging, and arbitrage. And the three functions of derivatives are good enough to build a more or less perfect market, or almost perfect market from the point of view of derivatives. We were talking, however, about hedging, and hedging is a counterposition that offsets the cash or commodity market position. Entering into derivatives contracts protects parties from future price swings. So, as we will be more specific later on, you try to avoid risk using derivatives. We have different types of risk, but especially market risk is where we are going to be focused. And of course, we are talking here about these two yellow boxes you have there. The equities world, where you can have a stock or an index, and commodities, where you can have oil, wheat, or any other commodity, right? We have been talking only a little bit. We will be more deeply into that later on about the product. Now we talk about the market. Where are derivatives traded? And this give us a clue to open the door of what Mr. Benjamin Benjelloun asked before, what would happen if there is a counterparty risk? Something is not appropriate in the market. We have two walls. In the left-hand side, you can see ICE, MEF, NASDAQ, Eurex, some derivatives markets. So we are talking there about a regulated market, an exchange per se, with an order book open to everyone, where you can find fair prices from the point of view of the market, but from the point of view of market risk, you can also have support in the sense that the CCP, as we will mention today in this brief session, I said brief session because we can be talking about derivatives 18 hours and we wouldn't finish. We will see that the CCP, the Central Clearing House or the Central Clearing Counterparty risk is avoided thanks to this other body strictly or narrowly linked to the market. So if we want to use the slide here, you can click on my face now. Probably you will see my face darker, but you can see properly the whiteboard. That's the purpose. You have the organize derivatives market, which is only part of the organized system. We can have as an example here MEF with the Spanish case, or Eurex, the German case, etc. And on the other hand, you also have a central clearing house, or CCP, which tries to avoid and find the good goal of the trade. Is taking care of the system. I promise I will not talk about football, but if this was a football match, it could be a football match with a referee trying to look after the rules there. As opposed to the right-hand side of your slide, where you have there in slide number 17, where you have OTC markets. They are non-organized markets. The nice thing about OTC markets is that you can trade whatever you want. So they are totally flexible. But bad news about over-the-counter derivatives is that they have, this is like a football match without referee, so not really rules. The only rules applies to this agreement between two parts, the buyer and the seller. So the buyer depends absolutely on the seller, and the seller depends absolutely on the buyer. So again, the nice thing about the over-the-counter markets, and that's the success of them, is that they are totally flexible. You can trade whatever you want as long as your counterparty agrees with the price and the rest of the characteristics of the product. But the bad news, and this is very strong risk, you have legal risk and counterparty risk. Okay. Any additional comments? Fine so far? Am I going too quickly, too slow? Good enough? Up to here? Good. Any question, please? Okay. Okay. If there are no questions so far, let me continue. Excuse me. Yeah, let me continue with an ETD. This is an exchange traded derivative, which means that you are in an organized market. Let's say a football match with a referee, okay, which means that you are basing your prices are supported or found through an order book, a central order book, as in the equity market, by the way. And the key benefits of trading ETDs are the following four. Deep pools of liquidity. So strong condition that a liquid derivative must have is that the underlying asset must be very liquid, of course. So you cannot really build a derivatives organized market if your underlying asset is not liquid. So if you have a strong, quite robust, strong equity equity market liquid or an index, then this is good input for a derivative, for a future or for an option. So deep pools of liquidity, price transparency, as in the equities market, the session you received last week. And they benefit from fair and orderly trading environment, as the exchanges have. Last but not least, you can eliminate default risk. So thanks to the CCP, this part you have here, the exchange at the end, this CCP is taking care of the good end of the trade, thanks to several mechanisms we are going to cover here today. Okay, as margins or variation margin or the access to the market by market members. We also have securities derivatives, so it could be a warrant or a certificate. They are tradable financial instruments designed to meet investor needs and to respond to different instrument strategies related to an underlying asset. Leverage products often incorporate an option component to take a leverage long or short position in the underlying asset, and they are sometimes located in the equity unit, given that they are a tradable financial instrument. I mean, a value, a traded value, so similar to shares or ETFs. Okay. This was just a small hint about the securities derivatives, but we will focus mainly in futures and options. We have been talking about risk, main risks associated with derivatives. I have been here talking about different risks quite quickly. Let me tell you about these risks you have there in the slide. Remember, we drew this pattern before. Remember, today is December 9th. Today is December 9th. We have our investor Pepito. He wants to buy a future at, let's say, 8,600 index points. It could if it's IBEX 35, it could be another index, doesn't matter. It's just an example. And you have the expiring date. The expiring date, which is December 17th. Okay, December 17th, where the stock could be in 8,000, sorry, the underlying asset could be in 8,800 or 8,600 or 8,400. Okay, so please, Jose, explain me what's a future. Yes, I'm just like putting colors in the whiteboard. Afterwards, we will define a future. But from the very beginning, now I can say that a futures contract for Pepito now means that today he is signing a contract, trying to, and again, please, you can click in my face, please click on my screen now, and you can see the whiteboard properly and bigger enough. Thank you. What Pepito is doing now, this investor, is signing a contract where he is obliged to buy IBEX 35, which could be the underlying asset, could be IBEX 35, for example. This would be the underlying asset. It's a future on IBEX 35 at this price, 8,600. So he's signing a contract today, December 9th, acquiring a compromise to buy IBEX 35 at 8,600, not today, but on December 17th, in a future date. This means that if Pepito buys a future, there must be some Juanito. Let's draw Juanito in blue. Juanito is taller, and he is selling. He sells a future at 8,600. So in the upper part of this red line, hopefully you can see it, in the upper part we have the buyer, and in the downside part we have the seller. Number one of this slide you have there, slide number 20, is telling you about credit risk. And credit risk is telling you the possibility that the party of one side of the transaction does not fulfill its obligations, provoking losses to the party on the other side of the transaction. So let's imagine trying to mix this a little bit with market risk. What is the best scenario for Pepito? The best scenario for Pepito, who wants to buy a future contract. This is a futures contract, okay? This is a futures contract. Okay, he's buying a futures contract. He's obliging himself to buy IBEX 35 at 8,600. So the good scenario for Pepito would be having an IBEX at 8,800, right? Because if December 17th arrives, he still has his contract where he is obliged to buy at 8,600 something, IBEX 35, whose price is 8,800. Okay, so he would have a net total profit. Is it clear enough? Comfortable? You follow me? Any question, comments so far? Yes, can we continue? Yes. Thank you. If not, please stop me. Okay. Okay, thank you. So let's imagine that we don't jump from today, December 9th to December 17th. We don't jump those several days there. We go to tomorrow. And tomorrow, IBEX 35 goes to 8,650. So let's imagine, excuse me. Let's imagine that tomorrow, IBEX 35 goes to 8,650. And the day after to 8,700. So the trend is to go up. If the trend is going to go up, he is very happy, okay? He is very happy, the buyer, because prices are going up. He's obliged to buy at 8,600, something whose price is 8,700, 8,800, so on and so forth. However, this seller, our blue seller is very sad, okay? He's crying here, okay? He's sad. Why he's sad? Because he's obliged to sell at 8,600 something whose price is going towards 8,800. So let's imagine that he doesn't like this scenario. He doesn't, in fact, like this scenario, and he tries not to fulfill its obligations. In some way, these buyer and seller are linked. They are linked. They are both counterparties. He is the buyer, he is the seller. Okay. So credit risk means the possibility of one of the counterparties, let's say the seller, doesn't fulfill his obligations or her obligations. Okay. Liquidity risk is the possibility of doing or undoing a position with enough rapidity. This is similar to equities. This is similar to fixed income. Liquidity risk is everywhere, right? And of course, liquidity risk is everywhere, but of course is higher in OTC markets, where you have an order book and a pool of buy orders and sell orders there. Then, as in the organized markets, then you have lower liquidity risk. It's not zero, but it's much lower. Operational risk. What would happen? We are not going in number 3 on this slide, number 20. What would happen in this operational risk when you you want to buy a futures contract or an options contract? We will see later on. What would happen if you try to, please, I take the phone here, I took the phone, please buy me 7 futures. And when the market member is going to type this order in the system, then collapsed. There's a glitch in the market and you cannot trade. So operational risk has to do with risk associated to the implementation of transactions, technical issues, complexity of products, level of education, indeed, in fact. Legal risk. Number 4, legal risk has to do with the lack of regulation or regulation gaps related to the financial innovation, but also due to the lack of rigor when analyzing the possible legal limitations of the different parties of the transaction. So let's imagine this scenario where Juanito, the seller, doesn't fulfill his obligations. Then the buyer is not going to be like that, doing nothing. He will try to act legally against the seller. And the legal risk tells you the possible gaps you can find when the buyer goes against the seller. Okay. And finally, last but not least, the market risk, possibility for a position or a portfolio to reach losses when unfavorable market prices exist. So market risk is not other thing that me, the buyer, if I want the market to goes up, and finally the market goes down. When I want that the market goes up, the market goes up. Or for the seller, he or she would like that the market goes down and the market goes up. So in other words, market risk has to do with the fact that I find unfavorable prices. The prices goes the other way I would like the prices to go on. So I want the market to go up and finally the market goes down, or vice versa. Any questions, comments? Is this clear enough? Good. Any question? Comfortable? Yeah. Okay, thank you. Then we are going to continue, if you don't have any additional comments, talking about one key aspect concerning market risk, volatility. This is not a mathematical class, but let me use a brief graph to try to describe volatility. Again, please click on me if you want to share the screen in a larger size. You can have here, for example, price and this is time, and prices goes up and down, up and down, up, and we can draw an average. This average, for example, is 8 euros, and the evolution of this asset, the underlying asset, it could be Telefonica, it could be Deutsche Telekom, it could be Telecom Italia, whatever. Any stock, for example, could go up to 10 or could go down to 6. So what we're trying to do is to find the relationship between every case, every xi, with respect to the average. And we add all these cases from 1 to n, where n is the number of days. For example, 250 days, 1 year. Okay. So we try to measure the distance between every price with respect to its average. So if you follow this graph, you can have an alternative price B with the same average, same mean, 8 euros. But this is a quite calm asset. It goes up 10 cents, it goes down 10 cents. So the distances here with respect to the average are much smaller. Of course, if we subtract 10 minus 8 is 2, and 6 minus 8 is minus 2, plus 2 plus minus 2 is 0. Do you think you have here volatility 0? Of course not. So you square it. You square it and divide it by the number of cases, which means that, please, try to forget about mathematics. The only thing I'm saying is we are measuring volatility as the distance between every price and the mean along the period. So 10 minus 8 or 6 minus 8. And you square it to avoid offsetting prices. And this is the variance. And the square root of the variance is sigma. Sigma is standard deviation. And standard deviation is the typical measure we use to measure volatility, to use volatility. Volatility is a statistical measure of the dispersion of returns for a given security or market index. In most cases, the higher the volatility, the riskier the security. And this is good for derivatives. Let me show you this with an example. Do you think they are both saying the same? Here you have A. You can see in slide number 22. A is having an average of 11%, and prices are around 11%, 10%, 30%, 11.20, 11.50, very near 11%, right? Is the average. Excuse me. Oh, I lost the control. Sarah, please. Presentation is not there anymore. Can you help me?
Let me.
Thank you. Okay. Let me jump down. We were here. Yeah. Okay. Apologize for this. What we are saying is in the whiteboard I was using, in both cases, the mean, the average was 8. But here, you can have an average of 11%. 11% for asset A means that you have 11%, 10.30%, 11.50%. It's all very around 11%. This is a very calm asset. However, for stock B or asset B, although the average is the same, 11%, you have 7%, 15%, 13%. So the calm asset, they're interchanged, right? The calm asset would be A here. This would be the calm asset. And B would be the volatile asset. B of volatile, okay? Just joking, okay? Okay, this is the volatile asset. So given that we have the same mean, we have abnormal returns here in asset B. So higher risk, higher volatility. And this is the key input for derivatives. This is the key input for derivatives. Let me now, if we don't have more questions or comments, go into financial futures, deeply into that. Comfortable so far, everybody? Yes? Good. Okay, if no other suggestions or comments are put in place, let me tell you about financial futures. You know, I have been drawing in my back. I have a whiteboard drawing Pepito, Juanito. What is the profile of a buyer of a future? This is the profile of a buyer of a future. This is the image, the real image, the technical image for Pepito, the buyer of a futures contract. Because remember, a futures contract is a contract obligation, an obligation to buy or sell an asset or financial instrument at agreed price at a certain point in the future. In our example, in the whiteboard before, the buyer's name was Pepito. The underlying asset to buy or sell was IBEX 35. The futures date was December 17th. Remember, the third Friday of the month. And the expiration date was again December 17th. And this is the real aspect of a buyer of profits, losses, price of the underlying asset, and we have this futures contract for the buyer, okay, where if the price of the underlying asset is here, you have a profit, as opposed to if the price or settlement price is below the futures price, you have a loss there. So your market risk is here. I don't like the market goes down if I am a buyer of a contract, a futures contract, because I have the obligation to buy at, let's say, 100, something whose price I don't know in the future, in a future date. Okay, this is the picture we have for the buyer, and this is the picture we have for the seller. The seller thinks that the market is going down. So the counterparty of this buyer is the seller. And the seller of a futures contract, profit and losses, price of the underlying asset, is this one. I don't like that the market goes up, because if the market goes up, I have a lot of market risk here. Remember, here the seller is obliged to sell at a price of, let's say, 100. So if the market is here in 80, he or she is very happy because he's obliged, look at my hands, please. he's obliged to sell at 100 something whose real price is 80. He or she is very happy that the market goes down and down and down. Okay. Okay. This is a short position, and this is a long position. A long position means to buy. It's just that, to buy. As opposed to a long position, sorry, a short position, which is to sell. Okay, which is just to sell. So this is not all thing what I'm talking about. The language, vocabulary associated to futures. This vocabulary is more extensive when we talk about options. Well, any questions, comments, comfortable so far? We are here to learn. Any doubt? Any suggestion, comment? Good enough? Up to here?
Jose Antonio, I do have a question actually.
Yes,
with
thank
regard
you.
to because it's the one thing I was actually hesitating on with regards to the expiration date. Expiration date means the date you mention in the contract between buyer and seller, where then you realize what the price of the underlying asset is, correct? So there's a change of the price in the period you mark, like let's say 6 months or 9 months, and the expiration date is the final date of this time window.
Yeah, that's correct. We fix a price today. Mm-hmm. And of course, we don't know which is going to be the real price 6 months from now. Yes.
Yes, you have your parameters, and you realize it might be down or up in 6 months period. So, but is it in theory? And that's what I was wondering. Is it possible to mark? Maybe no. Maybe now you clarified the question. Thank you. No, on the expiration date,
Okay. Thank you. Of course, the real aspect here, just to clarify, if I may, the real aspect here is we all don't know, not even analysts know what is going to be the real price 6 months from now. We don't know what is going to be, where is going to be Euro Stock 50 or IBEX 35 or CAC 40, okay? Or Telefonica stocks price, okay? So yes, any other questions, any other doubts or comments, please? Okay. We were in slide number 26, just sharing with you that a big part of derivatives is a language, is a vocabulary. Long position is not other thing than to buy. To buy means long position. That's it. Long position. How do you close your position? You close your position selling. So doing the opposite, selling. So this is the same as to have nothing. You are not in the market because before you bought and then you sold. Maybe this is putting it more simple with equities. If you have bought Telefonicas at 3 euros and you sell Telefonicas at 3.10, you have a gain, but you are not in the market. You have nothing. You have a gain because you bought at 3 and you sold at 3.10. You are not in the market anymore. So this is the same. Here you buy a future, you have this position, and if you sell the future, you are not in the market. You are out. With one nuance, one important nuance, that you can also enter the market with a short position, selling. Hey, if we are in the market, in the equity market, shares, if you sell Dutch Telecom, it's because you have Dutch Telecom. Look, these are my Dutch Telecom, this bottle of water. In other words, if I sell this, it's because I have it. If I sell this stock, these shares, it's because I have it. It's very obvious for equities, but it's not applied for derivatives, because for derivatives, they are a contract. They are not bottles of water. they are not a valuable traded value, they are a contract. So I can enter the market selling a position with a short position like this, and I can offset my position just buying. And if I buy, I'm not in the market. This is cancelled, this is offset, and I am not in the market. So remember, I can enter the market also selling if I am using a derivatives, because they are not bottles of water, they are contracts. And I can put my feet, my first feet on the market, saying I am obliged to sell at 8,600 on a future date, which is, for example, December 17th. Okay. This is the story about futures, but of course there is a fair price. What is a fair price? As opposed to the equity market, derivatives market is a valuation market. A valuation market, which is a main difference. The main difference with respect to the equity market. Let me show you this. Today the stock price is €9. And the expiration date here, expiration date is December 9th, 2022. So 1 year from now. 1 year from now. What is the fair price for this future? The fair price for this future would be the spot price, so €9, plus interest rates. Unless this stock I invented, this is a stock, for example, XYZ. This stock pays a dividend. If this stock pays a dividend, then, for example, here on September, they pay a dividend of €1. Then I have to subtract this dividend, taking into account the interest rates between September 1st and December 9th of 2022. Okay. In other words, the only thing we're saying is that the fair price, the theoretical price of a financial futures contract is the spot price plus the net financing cost. And this is true for every underlying asset. They could be oranges, they could be oil or stocks. Okay. The basics of this is the following. I have a final capital, which is the initial capital plus interest rate, right? So how can I extract the initial capital? The initial capital would be the future capital brought at present. Okay, we are looking for the future capital, which is this. Okay. With a nuance concerning stocks, because stocks sometimes they do pay dividends. A dividend means that it should be subtracted from the market value, the market price of the market. So that's why we have to subtract here. So if interest rates are positive, very small but positive, let me do this for pedagogical purposes. we all know that interest rates are almost zero or even negative, then future would be higher than the spot because this is greater than 1. Okay. Let's imagine we have no dividends. Let's imagine we have no dividends. There are no dividends for this stock. Then the future price could be the spot price plus interest rate. So if interest rate is greater than 1, then the price of the future is greater than the spot, right? This is contango, as we were going to see later on. Vocabulary again, okay? Any questions, comments? I don't want this to be a very mathematical, heavy content, but just to give you some ideas. Is it clear enough, please? Yes? Okay. Okay. If we add dividends, and there is a dividend from today, December 9th, 2021, to 1 year from now, December 9th, 2022, then we have to complete this formula, subtracting subtracting the dividend, and then I don't know if future is greater than a spot or not, because look, please look, this is, imagine still we have interest greater than 0, but the complete formula would be this one, which means that this is going up if this is positive, but this is going down. Okay, so I don't know if this is going up a lot and this is going down a little bit, and then still future is above spot price, or if we have the blue scenario where this goes up a little bit, but this dividend is lasting a lot, subtracting a lot, and then future is lower than the spot. In other words, sometimes the future can be above the spot price, and sometimes the future would be below the spot price. And the last comment I would like to mention before finishing this part about future contracts is that please don't think that this is a mathematical formula I drew here today just to show my whiteboard. This is really applied in the market, and my colleagues at the surveillance department in the derivatives market, they do have this formula because the market price converges into the theoretical price. So this is really applied in the market. And as I mentioned before, this last slide for futures, slide number 29, if F is higher than S, we talk about contango. It's just a way of naming things. And if futures contract goes below the spot price, this situation is named as backwardation. Just two names applied for these situations. We have been talking a lot about future contracts. Let me now change subject to financial options. Any question, any comments? Comfortable so far? Yes, good. Any question, please feel free to interrupt or use the chat. Thank you. We were talking about vocabulary, and if we talk about options, then vocabulary extends so much. Call option, strike, put option, expiring date, break even. It's not as complicated as it may appear. What is an option? A contract that gives its holder the right to buy, if it were a call option, or the right to sell, if it was a put option, a particular asset or financial instrument at an agreed price, which is the strike price at a certain point in the future. Again, an expiring date. The option contract is a forward economic transaction, and the key aspect I would like to mention here is that we change one word. For futures, we were obliged to buy or obliged to sell. If you buy a futures contract, you are obliged to buy. If you sell a futures contract, you are obliged to sell. For options, you have the right. you have the right to buy a call option or the right to sell a put option. When the expiration dates arrive, when the expiration date arrives, there are no obligations for both parties of the transaction, not only for the seller. The buyer has the right to do that. We have call options, which gives you the possibility to buy, right to buy, or right to sell, if we are talking about a put option. Let me show you this with one example. Just before that, let me be clear about American options and European options. It has nothing to do with the continent. American options means that you can exercise, you can decide if exercising or not at any date, any time up to the expiring date, also at the expiring date, but also before. However, European options, you can exercise your option only exactly at the expiration date. The best thing to approach this, I think, is to share with you some examples. Let me tell you about a call option for the buyer. Let me use the whiteboard. We have profits, losses, price of the underlying asset, Telefónica stock at 3, and you pay €1. You pay €1. That's why you have an initial payment, an initial loss. You pay €1, and please, you can click in the whiteboard to see larger the screen. Probably it would help. Thank you. You pay €1 to have the right to buy Telefónica's stocks at the price of 3. So if at the expiring date, Telefónica's price is at 5, for example, on December 17th, 2021, the third Friday of this month, then you exercise your option, right? Because you have the right to buy at 3. Please look at my hands, please. You have the right to buy at 3, something whose price is 5. You gain 2. You gain 2. Hey, but the price you paid was 1. So you gain only 1. The difference between 3 and 5 is 2. But given that you pay a price of 1, then you gain only 1. Right? Okay. Okay. Let's imagine now that in a future date, 6 months from now, we were mentioning before with the question of Mr. Benjamin, the price is 1. If the price is 1, I still have the right to buy at 3, something whose price is 1. Hey, but this is useless. This is not interesting. I don't want to buy at 3 something whose price is 1. Then I do nothing, but I paid €1 that I lose. Okay, but this is my potential maximum loss. If the price is 0.10, my maximum potential loss would be still be 1. So I have a limited negative situation and unlimited positive situation. Limited profits and limited losses. Okay. But of course, if there is a buyer of an option, means that there is also a seller of the call option. The seller of the call option would have this idea: positive, negative, profit, losses, price of the underlying asset, Telefónica's at 3. He or she received €1, so €1 positive. To have, remember, this have the right to buy, I have the obligation to sell. So let's imagine, of course, if I receive money, I always say that this is like life itself. And this is also true for put options. If you pay, you have the right to do something. You are having a meal in a restaurant. Please bring me coffee. Please bring me the fruit. You pay. Okay. You you earn a salary. You are obliged to work. Okay. So if you receive money, you are obliged to do something. Obliged to sell. If he or she has the right to buy, you are obliged to sell. Okay. So let's imagine now that Telefónica's price is 5. If Telefónica's price is 5, this is 5 here. I don't know if you can see properly. This is a 5. 5. What do I choose to do? Well, you are not really subject to do nothing, to choose nothing. You are subject to your counterparty. Your counterparty has the right, he or she, the buyer of the call option, has the right to buy at 3 something whose price is 5. So he will do that. So I am exercised. My option is exercised, meaning that I am obliged to sell at 3, something whose price is 5. So I lose 2. Given that I receive €1 here, then I lose only 1. Okay. What would happen if the price were 1? If the price were 1, the price of Telefónicas were 1, what do my counterparty would do? He or she would have the right to buy at 3 something whose price is 1. He doesn't do anything. I'm not touched. Then €1 I receive, €1 I keep. This is not a very nice picture. It's not a very nice picture because I have a maximum possible gain of €1 and a potential illimited loss. We will see later on that he or she, this position, has its reason to be there, its reason to behave. Any questions or comments? This is probably the most technical part of the session. Do you follow me? Any comment? Good? Yes? No? You can stop me. You can raise your hand. You can. Okay. Thank you. This is the story. This is the story for a call option. But for a put option, for the buyer, it has this situation where it has positive, negative, Telefónicas at 3. It could be Telefónicas at 3. He or she would have to pay €1, have the right to sell at 3, Telefónicas at 3. So if Telefónica were at the price of €1, the buyer of the put option has the right to sell at 3 something whose price is 1, which is very good, right? To sell at 3 something whose price is 1 is very good. I gain 2. But given that I paid 1, I gain only 1. Okay. I like the market goes down, because if the market goes down, then I have a profit. However, if the price of Telefónica is 5, I still have the right to sell at 3 something whose price is 5. I have the right to sell at 3 something whose price is 5, which is not very interesting at all. Right to sell at 3 something whose price is 5. I do nothing. I pay €1. €1 is my total net loss. Okay. But of course, and please note that I don't need to have Telefónicas. There is a physical delivery or cash settlement. If there is a cash settlement, I don't need to keep the Telefónicas, to have the Telefónicas, the stock. However, if it's physical delivery, then yes, if I have the right to sell, then I need the bottle of water that I'm selling. Okay, in this case, the stocks. Okay. Of course, if there is a buyer for a put option, there is also a seller for a put option. The seller for a put option would be this scheme, positive, negative, Telefónicas, and I have this scheme where I receive €1, I receive €1, and if the price is 1, I am subjected to, remember, this guy has the right to sell. So I have the obligation to buy when he or she wants. So if the price is 1, then my counterparty is going to exercise. So I am obliged to buy at 3, something whose price is 1. So I lose 2. Given that I receive €1, I only lose 1. Okay. And on the opposite side, if the price of the stock is 5, he or she, the guy that has the right, is going to do nothing, then I'm not touched. This means that I have a net profit of €1. Any questions? Any comments? Good so far? Yes. Thank you. Thank you. Just one comment to share with you, because we probably, from the point of view, we will talk about this later on at the very end of the session, from the point of view of the policymaker, of course. Let me first conclude the side of the investor. We didn't like so much this position, this blue position here I am putting a zero. I don't like so much this blue position because I have a limited profit and unlimited loss. And this position is also very unfair from my point of view of trying to do business, because I have a limited profit and unlimited losses. So what is the sense of all of these two positions? Please let me be clear about this. Let's imagine that I think that the market is going up. I think that the market is going up, and I have Telefónicas at 3, again, could be any stock, whatever. And I think that the market is going up. So if the market is going up, I would do what? I would be a buyer of a call, right? The buyer of a call have this position. As long as the market goes up, I have a lot of benefits here. However, the drawing you have in slide number 36 is also an upward position. This upward position is a put option for the seller. Let me draw these two. This is a put option for the seller. Selling a put, buying a call. Which one should I choose if I think that the market is going up? Let me put here, maybe you can see properly the screen. A, black line, buyer of a call. B, red line, seller of a put. C, none of them. is one of them. What do you think? Probably most of you would choose the buyer of a call, because the buyer of a call finds a lot of benefit, possible benefits, as long as the market goes up. Let's imagine that the client, you think, you the investor, we will change to the policymaker later on about derivatives. Let me first understand this. I think that the market is going. If the market is going up, I will always choose a buyer of a call, because as long as the market goes up a lot, I will gain a lot. However, this seller put option is a useless position. It could appear in the first side, because I only have a limited profit, always limited, the boring euro, the boring €1. Okay. Let's imagine that Telefonica goes up. You know how much goes up? 1 cent. 1 cent. It goes up, but only 1 cent. With 1 cent going up, with selling the put option, you gain the whole euro here. You gain €1. However, with the call option, you lose money. You lose money here. So it was not useless position. It was just a moderate upwards position. Of course, we all like a call option, a buyer call option, but only after this point. From this point on, you always gain more with the buyer call option. But first you have to reach this. And this is, if this is 1, I can tell you, not today because it has more technical issues here that we cannot cover now. This is a price of 5. Do you think that Telefonica goes from 3 to 5 in a short term? It's not the case. Probably we mentioned that now, and now we look at the screen once the session is finished, and this is 5.40. But in a long period of time, if you look at stock exchanges price evolution, you see moderate upward situations and moderate decreases. I'm not doing an investment recommendation. The only thing I'm saying is that this seller of put has its own sense, because he or she would gain some money between the price of 3, which is here, and the price of 5, which is here. In all these window, I would gain more money with the put option. And apparently it was a boring situation. It was a boring profile because I had a boring euro to gain. It has its sense. Just to finish this part of options, if you don't have any questions or any comments, I would like to point out that one key aspect here, when we drew here this, I will mention this, for example, call position, profits, losses, price of the underlying asset, and you have Telefonica at 3. I said, I pay €1 and I have to write the right to buy Telefonica at 3. Why? Why €1? Why the price is not 1.10 or 0.90? Where does this price come from? Before, we have been talking about the fair price, the theoretical price of a future. Remember? Derivatives markets, and now we are going to change to exchanges and derivatives markets, in fact, is a valuation market. So the fair value of an option, has to do with different key variables influencing the option price, as the strike price, time to maturity, interest rates, the price of the underlying asset, of course, volatility, and dividends. All these 6 boxes you can observe there in slide number 37 influences the fair price of an option. But of course, this should be taken slowly, and slowly means probably more than 6-hour training to understand all these variables around option prices. Just to let you know that all these 6 variables are behind the fair price of an option. Let me change chapter to exchanges. We have mentioned before that this derivatives market can be traded in OTC markets, where you have a bilateral agreement, tailor-made contracts, and of course credit risk, as we mentioned before. You can see that in slide number 39. And in the downside part of this slide, you can also observe organized markets, where there is a key player, which is the central clearing party. There is a standardization and good end of trades. You have certain, you are safe. You're safe if you are an investor in an organized market, as opposed to OTC markets, given that legal risk is 0 and credit risk is 0 for organized derivatives market. A regulated derivatives market, whose main traded products, ETDs, are future contracts and option contracts, has the following key tasks. It defines the main characteristics and specificities of the contracts. It facilitates trading. It disseminates real-time information of prices, volumes, open interest, and market depth, as in the equity market, by the way, with the exception of open interest. And it orderly organizes the market. It provides management and surveillance of the market and its listed products. And it celebrates agreements with the central clearing counterparty, because, as we mentioned before, the CCP is in charge of aiming the good end of transactions. The main safeguards of the architecture of the market. Exchange has the following types of different players: speculators, hedgers, and arbitrageurs. We mentioned that before. A good market, a good derivatives market, has a certain amount of the 3 of them. Sometimes you say only speculators, only hedgers. Well, the market quality of a derivatives market is guaranteed if the 3 types of players, speculators, hedgers, and arbitrageurs, are participating. Speculators are participants that wish to take a position in the market in accordance with the expectations of the evolution in the price of the underlying asset. Remember, this evolution of the price of the underlying asset is unknown. We don't know if the market is going up or down in the next few days. Hedgers are, they want to avoid exposure to adverse price movements in the price of the underlying asset. Remember the example of the baker and the farmer. And arbitrageurs, participants that want to lock in a riskless profit by simultaneously entering into transactions in 2 or more markets. In some markets and for some participants, it is quite difficult to implement because you need to be quick. You need to be quick enough. And on the other hand, you also need to have a certain amount of money. Maybe Pepito, the small investor, is not quick enough. You know, he needs some time to pick up the phone and call, you know, and he also have maybe 1,000 euros. It's not so much. But remember, Pepito can join an investment fund, for example. So in an investment fund, he can join some other Pepitos, some other small investors, and at the end they can do also arbitrage because they are confident of the know-how of their professionals there of the investment fund. Okay.
So, Jose Antonio, just a question.
Yes,
so
sure.
Is it then ultimately the hedger which is bringing the liquidity to the exchange? The big amount of liquidity you talk, which is needed sometimes to trade? Because from the other 2 market participants, I would not expect the same amount of liquidity.
Thank you for your question. Very interesting, by the way. Maybe you're right. It's not true for arbitrageurs because they are very quick in the market and they go in and out rapidly. So they are not providing liquidity so much. You are totally right in that sense. However, speculators, no, not for speculators, because for speculators, they have their position there. So they are feeding liquidity, in fact. Of course, hedgers, as you pointed out, of course, hedgers, but also speculators. Speculators, as Pepito in our example, the upward position or the downward position, they are present in the market and they can provide liquidity. Yes, sure. Yeah.
Because they're risk, because they're hedging, obviously, because there's a lot of at stake for them in terms of what either the commodity or the other product they want to buy on in a specific on a specific date, as we explained earlier. So this is, I guess, a hedger is doing this actually quite frequently. You mentioned, for example, the example of the airline company, which is buying in which is anticipating the fuel price.
You mean for the hedgers?
Yeah.
Yes, sure. For the hedgers, yes. They can also be quick, but I would say if we are talking about liquidity of the order book here, the biggest part of these three actors would be for speculators. Yes. Not for hedgers, not for arbitrageurs. Both are very quick in the market and they go in and out very quickly. Yes, you're right.
Thank you.
But it's not the case for speculators. Thank you. Thank you for your question. Any other comments, suggestions or thoughts? Okay, thank you. Let's see an example, because how do you hedge a position? You have a long position. You can observe that here. You have profit, losses, you have a long position, and then you hedge your position with a short position, and at the end you have a net profit or a net loss. Okay, let's see an example with numbers, because this is a simple graph, and simple graphs can be clear enough, but maybe you can write whatever you want, right? Let me show you this with numbers. If a participant, and this is an example of hedging with a futures contract, please look carefully at the slide number 43 for this example. If a participant holds a long position in cash of 10 IBEX 35 baskets at 10,000 points, and a hedging position is tried to be implemented selling 10 future contracts at 10,010 points, 3 questions. What is the net final payoff? What expectations about the price of the underlying asset has the final total position? And what would be the final total payoff if the price of the underlying asset were 9,880 or 10,000 or 10,120? Well, first question, you have 10,010. You have 10,010, which is the price of the future, and 10,000, which is the price of the underlying asset, multiplied by 10, because there are 10 baskets, and multiplied by 10, which is the multiplier to pass from points to euros. Then you have 10 multiplied by 10 multiplied by 10. Then you have 1,000. 1,000 potential benefit. And the second question is, okay, what expectations about the price of the underlying asset has the final total position? And the answer is indifferent. I don't care. I don't care about the price of the underlying asset. Come on, you don't care? Please demonstrate. And in section 3, we try to demonstrate that the final total payoff if the price of the underlying asset is, let's say, 9,880. I don't know if you are able to see my mouse here. If you are able to see my mouse, I am signaling 9,880. So you lose 120. Multiply by 10, multiply by 10. You lose 12,000 euros. Why? Because you bought at the price of 10,000. And if you bought cash at 10,000 and the price is 9,880, you lose 120. Multiply by 10, multiply by 10, you lose 12,000. However, the futures contract was 10,010. 10,010 minus 9,880, you gain 130. Multiply by 10, multiply by 10, you have 13,000 plus 13,000. Minus 12,000 plus 13,000, you gain 1,000. Hey, you were lucky. What's the case for 10,000? If 10,000 were the price and you bought at 10,000, you have 0 because you bought at 1,000 and 10,000 is the price now. So you have 0. However, concerning the futures contract, you sold at 10,010. So 10,010 minus 10,000 is 10. 10 multiplied by 10 multiplied by 10, you have 1,000. 0 plus 1,000, 1,000. And in the case of 10,120, if you bought at 10,000 and you have 10,120, you gain 120 multiplied by 10 multiplied by 10, you gain 100. Sorry, you gain 12,000. You lose with 11,000. You always gain 1,000, regardless of the price of the underlying asset. You always gain the base, the difference between the futures price and the spot price, multiplied by 10, multiplied by 10, so 1,000. Of course, if the quoting of the futures contract would be the opposite, then you would always lose 1,000. But maybe you prefer to lose always 1,000 better than to lose possibly 45,000, right? So what we try to demonstrate here is that it's not true that hedging a position means that you don't lose. You can gain, and you can gain always, or you can lose, and you can lose always, but a specific fixed amount, okay? We have been talking about exchanges. Any question about this example? Any comment? Can we move to central clearing counterparty? Yep. Okay, thank you. Central clearing counterparty, the piece of the market that guarantees the good end of a transaction. Because the buyer, Pito, through a market member buys, and the seller, Juanito, through a market member sells. And the central counterparty acts as the buyer for the sellers and the seller for the buyers. So I am in the middle trying to guarantee the good end of the transaction, regardless if one counterparty has a problem, would be a problem between that counterparty and me, CCP. But the seller is not affected by this fact. How does the CCP guarantees this function, this safeguard of the market? The credit risk is automatically moved to the CCP, and the mechanisms used to avoid a failure of a contract are the following: restricted access to the market, to the member status, variation margin, margin requirements, and operative limits, and daily stress tests. We will explain some of them in the next few slides. Okay. So these four tools are used by the CCP in order to avoid credit risk or legal risk. The CCP has a number of members who must post funds with the CCP. The main task of the CCP is to keep track of all the transactions that take place during the trading day. Therefore, each position is valued at market prices on a daily basis. This is called variation margin. And let me show you in the next two slides an example about this. Every day, let me show you this. Remember this afternoon when we were fresh, we drew December 9th, 2021. We drew Pepito, and he was the buyer of future contracts. A future contract at 8,600. But tomorrow the price is 8,650. And the next day, this is D+1. And in D+2, we have 8,630. So if this is 8,650, I give you +50. And if the following day goes from 8,650 to 8,650, I take from you 20. So every day CCP, I give you money if you have profit, or I take you money if you have a loss. Let me show you this example. This is an introductory example. Let us imagine a situation where a buyer and a seller agrees to exchange an asset within 2 days at a price of 100. So if I try to exchange at a price of 100 and the first day, day 0, is 97, I lose 3. And if day 1 goes to 103, from 97 to 103, I gain 6. From 103 to 105, I gain 2. So total variation margin is plus 5 because I wanted to buy a 100 and the next last price is 105. I gain 5. So every day I provide you with some money if you earn some money, and I take money from your account if you lose money. A mark to market. And here there is an asymmetry with respect to equities, to stock. Because when I buy a stock at 10, I buy the stock, okay? Day 1, day 2, day 3, and when I sell the stock at 8, then I have a net result of -2. This is for the stock. However, for a future, every day, I have profit or a loss, and on a daily basis, I receive money or I lose money, such that I have a perfect picture of what's my financial situation every day, as opposed to stocks. There is an asymmetry here. Any questions, any comments? Comfortable so far? Yes? Good? Okay. Okay. Let me now tell you about this collateral margining or the default management of the CCP. The clearing margins are the amounts required to members and clients in order to cover the specific failures of the obligations acquired by these members and clients. So on one hand, I have a margin that CCP, I require a margin. And on the other hand, I have this variation margin, okay? The concerning margins, the above also means that certain financial assets can be used as collateral according to the specific regulation of the CCP. And it is also important to point out that different categories of types of margins can be considered in the global structure of risk management of the CCP. So we don't only have initial margin, we also have margin call, collective margin, etc. This is the picture. This is a comprised version of what you can find in this architecture of the CCP. We go from the base of this pyramid to the top. In the base, you have the position margin. This margin you have to deposit when you open a position, when you buy a future or when you sell a future. Then you have individual margins or contribution of individual margins, margin contribution of the central clearing party, collective margin, and own resources of the CCP. So this pyramid from the base to the top means that risk is being higher and higher. I'm not saying that Pepito, our small investor, is having a default. I'm saying that a big market member is having a default. And this is contemplated in the regulation of the CCPs. And by the way, about the regulation is going our next topic. If I may, I would emphasize some key challenges concerning regulation of this aspect. The first aspect I would like to mention here is that CCP, let me draw this in the whiteboard. Is between the buyer market member, CCP, and here is the seller, market member. Okay, okay. So this is the key part, trying to guarantee the good end of transactions. It's not the market, it's the CCP. Okay, in the case of Spain, it's a BME clearing, but you have some other in Europe. So this means that this body here is a risk manager. It's a risk manager. It's not a risk taker. It's not a risk taker. It's a risk manager. A bank is a risk taker because a bank takes deposits and provides credits. This is a totally different story for a CCP. A CCP is a risk manager, okay, between buyers and sellers. And the regulation overview, and of course this could be extended more than 7 hours, is MiFID II, MiFIR, EMIR. Well, derivatives is one of the main areas that have experimented regulatory reforms after the financial crisis. I'm talking about the financial crisis of year 2007 and 8, which clearly showed that the systemic risk of OTC derivatives, given the low levels of transparency and insufficient control tools at that time. The reforms introduced by MiFID II and derivatives can be summarized as follows: more pre-trade and post-trade transparency, trading of products in organized markets, and enhancements of the liquidity through more strict mechanisms and flexible incentives to market makers. The main implications of MiFID II, or more implications of MiFID II or MiFIR, are more control about the functioning of the good governance of all trading venues, and a new system of keeping information about the orders available for its checking, known as ORK, order record keeping. Following the G20 commitments to increase transparency for OTC derivatives, in 2012, the EU adopted the European Market Infrastructure Regulation, aiming to increase transparency in the OTC derivatives markets, mitigate credit risk, and reduce operational risks. EMIR includes the obligation to centrally clear certain classes of OTC derivatives, and for non-centrally cleared OTC derivatives contracts, EMIR establishes risk mitigation techniques. EMIR identifies 2 categories: financial counterparties and non-financial counterparties. Following a review of EMIR in 2015 and 2016, the Commission proposed a first set of amendments to EMIR, known as EMIR Refit. The majority of provisions with the EMIR Refit entered into force on June 2019. And in June 2017, the Commission proposed a second set of amendments to EMIR, known as EMIR 2.2, designed to enhance the supervision of third country CCPs. EMIR 2.2 introduces a set of criteria to be considered as ESMA to determine whether a CCP is systemically important or likely to become systemically important for the financial stability of the EU. The regulation entered into force in 2020. And recovery and resolution. Recovery and resolution in the next legislative step in implementing the G20 objectives. It complements the high standards, already high standards implemented through EMIR, and confirmed the CCP role as a neutral risk manager for financial markets, not a risk taker. And the objective for recovery and resolution for CCP is to define measures to be taken in extreme but plausible events of financial distress. The key objective here is to exclude the use of public resources and increase the stability of financial markets. The CCP Recovery and Resolution Regulation was adopted in December 2020. The regulation entered into force in February 2021 and will apply from August 2022, except for certain specific provisions and amendments. ESMA is working on the corresponding level 2 mandated regulations. Of course, this is a forced exercise because we have not so much time to interestingly spend here. Because as I mentioned before, only about regulation we could spend 7 hours or maybe 20 hours and we wouldn't finish. And this is all from my side. Thank you very much. Thank you very much. And now there are some minutes for questions, comments. Thank you. Yep.
Thanks a lot, Jose Antonio. So as Jose Antonio said, the presentation was very comprehensive, and we understand there is probably quite a lot to digest. But if you have any final questions, please don't hesitate to ask it now, or otherwise you can always contact the Secretariat afterwards and we will provide you all the details. So if there are no additional questions now, then I would like to thank you, the participants, and Jose Antonio for joining us today. As mentioned at the beginning, the slides will be shared via email, so any follow-up questions, feel free to contact us. As mentioned at the beginning as well, we will have an additional webinar on retail investor participation, which will take place early next year. So if you are interested, please contact us and we will send you further details. Okay, so if no other comments, then thank you very much, everyone, and have a very good evening.